All right, alert. We've been talking a lot about the 6173, 6174, and 6174A letters that have been going out to crypto traders. These are letters that crypto traders are receiving. They're very vague scare letters from the IRS saying, we knew you were trading cryptocurrency in past years. Maybe you didn't report it correctly. Here's some ideas on how you should report it. That's the text of the letter. They don't tell you what year you didn't report, even though you're limited on going back 3 years to amend a return. They don't say what year it is. It's a big scare. It's very scary. And they're getting the information from Binance, who almost every crypto trader had a Binance account back in 2018 and 19. This is the reason they send out these letters. And if you don't respond to the CP 6174 letters, then it is highly likely that within about 6 to 8 months, you're going to get a CP2000 letter where they're going to assess some tax on income that the IRS knows about that they think you didn't report. So this could get ugly starting in January of 2026. Crypto exchanges will be reporting to the IRS all your sales and transfers from the prior year, 2025. These are going to be very scary documents. Let me tell you why. First of all, for the sales, it'll just show the amount of the sale and not the cost of the sale. So it could look like you made a lot of profit. It misrepresents to the high side how much income you made to the IRS. Secondly, transfers can be treated as taxable events. While you may transfer to your private wallet or transfer back from your private wallet as a deposit back into your, say, Coinbase account, Coinbase is going to report both those transactions to the IRS, but they're going to report the cash value of those transactions. Why? Because a transfer in could look like you were being paid by somebody. The reason here is you have to be able to prove that the wallet address was your own wallet address. The IRS has no knowledge what your wallet addresses are. So a transfer in can look like a payment. A transfer out could look like you sold something and or paying for it, which would be a liquidation, to be taxable. So it's going to create a lot of big numbers. It's going to require a lot of work to reconcile that, to get those numbers down to a meaningful capital gains that doesn't distort to the IRS how much money you make. So this can be very problematic this year. I think a lot of crypto traders are going to get CP2000 letters because of this complexity this year coming up in 2026. So make sure you know about that. Make sure you're dealing with a tax preparer who is very alert to how cryptocurrency taxation works. How does this affect crypto traders having CP2000 letters? Well, starting in January of 2026, the IRS has required that all crypto exchanges issue Form 1099-DA for digital asset to you and to the IRS by the end of January. This document, at least beginning in 2026, will simply list your total proceeds from every transaction that you have. So the IRS is going to get a 1099-DA for every single transaction that you make that involves selling or transferring an asset. They're going to learn every single transaction. What they're going to learn about is the proceeds, how much you got from that sale. What's not being reported is how much it cost you. So it gives the appearance to the IRS that you made a lot of money, potentially. Also, the 1099s will be reporting your transfers in and out of your wallet. And so Coinbase will be reporting to the IRS the amounts of coins transferred in and out and what address did the sending or receiving. That is the wallet address. So they're learning about every single transaction. This is a significant amount of visibility that the government's going to have. So it's very important for you as a crypto trader to make sure you account for all your 1099 DAs on your tax return. Otherwise, you'll get a scary CP2000 letter. A lot of people say, is a CP2000 letter correct? Virtually never. Here's why, particularly for crypto traders. When they get a crypto 1099 from a crypto exchange firm, it never tells what the real cost was of a transaction. So it just shows income, and they think it's 100% income and they tax you accordingly. I've seen people who have been charged with taxes in the $300,000 range only to have us get involved and demonstrate that no, there's not $300,000 of tax here. It's a far smaller number or was already accounted for. It was a clerical error, but it requires help to respond quickly. If you don't respond crisply and cleanly the first time on a CP2000, they're just going to proceed forward and assess the tax and make you work it out in tax court. So it's highly important that you do this. Why are CP2000 letters important to crypto traders? Well, this is the new tool that they're using to audit crypto traders. Let me explain. IRS got significant amount of transactional data from Binance when they sued Binance and they were able to throw CZ into prison for 4 months. They got all transaction data that involved people with US IP addresses, US accounts, any sort of US connection. They got your transaction history information. The IRS has been mapping that over the past year to people's tax accounts by cross-referencing them on exchanges like Kraken and Coinbase to find out who the people are, what your tax numbers are, because Coinbase has your tax numbers. So based on this, they are now saying, we know that you have transactions on Binance and you didn't report any crypto transactions on your tax return. Here's a CP2000 letter we're charging you. It's a computer generated audit, so it's going to be very scary. You got to move very quickly on it. That's why it's so important for crypto traders to contact our office. We'll be happy to discuss the details with you, the statute of limitations, the risks, the exposure, and give you advice that's tailored directly to your situation. You can reach us at CryptoTaxAudit.com, go to the contact page, and talk to our director of customer service.